The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Friday, everybody. Welcome to Squawk Box Europe. I'm Steve Sedgwick with Ian King, of cool people. Nice to see you, Kingy. Right, these are your headlines. Treasury yields rise after robust jobs data. Well, let's say it's just complicated the Fed outlook somewhat, but Japanese bonds continue to face pressure ahead of an expected rate hike this month.
Netflix reportedly wins the race for WarnerBros Discovery in a move that would mark a dramatic shift in strategy for the streaming giants. Meta shares rise as the company reportedly plans sweeping cuts at its Metaverse units, continuing its pivot to AI.
Oh, what a pleasure to see you. How are you doing?
Thank you. Good to see you too.
Yeah, well, I mean, I've only known you for 25 years, and now we're finally anchoring together.
It was inevitable.
What happened to your career that you ended up sitting here with me?
It's only upwards, Steve, yeah.
Maybe. Look, there's so many fascinating things we can talk about, and you and I always talk about these things behind the scenes as well. But I think there's a great, I don't know if it's cognitive dissonance, but there's certainly a great asymmetry about market reaction to data and stuff at the moment. Let's take this week in the US, and the ADP payrolls figure was dire, and it was much worse than expected, and people got really concerned. Actually, they didn't, because they got excited. They thought, oh, we're going to get our rate cut. We're going to get further rate cuts. Therefore, we can buy the equity market. Yesterday, initial jobless claims, some of the lowest levels we've seen in 3 years. And I know it's a volatile series, but all of a sudden, everyone's ignoring that side of the equation. Yeah. So they're only concentrating on the good news at the moment.
You've got, I mean, there is something in it for everyone. What we've seen this week for the data. I guess it's all eyes on the Fed now next week, isn't it? I mean, it feels like a Fed cut is baked in.
I think so. Yeah.
I mean, that really does sort of stoke the bull case a little bit more.
It does, but I kind of think, how long have we, as you say, baked in? So it's been 80-odd% for quite a while as well. And we would... I think there are back channels. If the market's really getting this wrong, again, this is just my view, that actually the Fed would say, steady your horses a little bit, or the message would get out there that it's not slam dunk 25 basis points as well. It looks like it's 87% according to all the markets now that it's coming in. So you tick that. But I think what the market must be, if it is buying on that trade, it's buying on the anticipation that there's going to be some form of dovish commentary or insinuation from the Federal Reserve that they can accelerate. But data like yesterday where, and I'll just reiterate the point, I'm sure we're going to do it many times as well, jobless claims for the week ending November 29th, and I know it's volatile, totaled a seasonally adjusted 191,000, down 27,000 from the previous period, way below estimates, and some of the lowest levels in years.
Yeah.
It's complicated.
Yeah, and the Fed are clearly very worried about that, but they're also very worried about inflation. So it's a really. I mean, you were talking about it the other day. The Santa Claus rally. Didn't look like we were going to get one. Then we did.
I'm just glad we had a session yesterday where it was flat, because my producers, wonderful, they're like, Santa Claus rally on, Santa Claus rally off, Santa Claus. They're going to do it all next week, I tell you.
I don't think really market participants know what to make of, how do you weigh up all this stuff? There are so many conflicting signals coming out of the US economy right now, as you say.
But I think the other way they can develop this is not stress too much about top down, but actually just look at bottom up. And bottom up, by and large, the earnings figures have been fantastic stateside again. So the case for US exceptionalism from the equity side, I think is still in place.
Yeah, but I mean, very good point. But if you miss expectations, you get punished. I mean, Snowflake yesterday was off, 11%, something like that, I think. So if it's great. If everyone's now expecting people to hit expectations or beat them, if you miss, you get spanked.
And then there's the case, of course, of the big driver, which is AI. And I can't remember if the market wants people to spend on AI or not at the moment. I think it's not. It depends which way the wind's blowing, doesn't it? But I think it's don't spend too much on it at the moment, but spend enough to justify your existence.
No, except obviously the macro guys do. Because that's all baked into their assumptions on what's going to fuel GDP growth next year.
Unless they start worrying those macro guys about the overall debt load of US corporates. But you never know which way they're going, do you? So let's take a quick look at those US markets, which, as I say, decided to ignore the fact that the jobs data was way better than expected compared to the fact earlier in the week that they rallied when it was worse than expected. So this is what the US markets did in session. Absolutely zip. I know there's been some interesting moves to the upside, actually, on the Russell 2K. I'll just tell you that the R2K, actually, week to date is up 1.2%. So outperforming a lot of those major indices as well. Just interesting to see how broad brush the rally is. And if you want to see what used to be a big indicator of the markets, I don't think people look at it so much now. Transports, how many sessions in a row do you think they've had up? I know, 9. Who'd have thought it, eh? Anyway, let's take a look at the broader indices week to date and the major indices. And you can see on the screen there that we've seen the Dow barely doing anything week to date, as indeed the S&P, and the Nasdaq mildly higher, 0.6% higher on the week. 10-year yield, well, this is interesting. Is the 10-year yield being driven by domestic factors such as Kingy and I just mentioned, or is it being driven by what we're seeing on the other side of the Pacific? And I'm not talking about in China, I'm talking about in Japan as well. And there's a lot of smart commentary which is resurfacing for a subject we talked about earlier in the year. That is, if Japanese yields pick up, what does that mean for flows? What does that mean for the willingness of strangers to fund your big deficits?
Yeah, I mean, the market is an unknown territory. I mean, how many market participants have ever experienced Japanese yields, JGB yields rising like this? I mean, this is...
It's been decades.
Yeah. And of course, as an old trader, the graveyards are full of people who've bet against JGBs over the years and all the rest of it.
Less of the old Kingy. No, X, I like to say. Absolutely right. OK, let's have a look at the European futures and where they're currently trading as well. We are called higher across the board with the CAC 40 seen 0.5% higher. Let's have a look at the week today. It's not been particularly exciting, to be honest. The Euro Stoxx actually is up 0.4%, but the individual bourses, the Xetra is mildly high. I think they're doing this on purpose, Ian. Look, that font is so small I can barely read it. But down 0.1%.
I'd have brought me opera glasses if I'd known.
Or a telescope, or the Hubble telescope or something. Yeah, let's have a look at the US futures and where they're currently trading. We are seeing higher across the board. Right, do you want to go into detail on those jobless claims?
Yeah, well, you just did. You've gone through the card already. Initial jobless claims fell to 191,000 for the week of November the 29th, down from the previous week when initial claims were 218,000 to the lowest level since September 2022. This led to a slight pairing of rate cut bets for the Federal Reserve's next policy meeting. Well, investors are hoping today's delayed inflation print will provide some much-needed clarity around the outlook for the economy. It comes ahead of the Federal Reserve's policy meeting next week, with a majority of investors expecting a quarter-point rate cut. Well, speaking to our US colleagues yesterday, Morgan Stanley's chief US equity strategist, Mike Wilson, said he doesn't think the market is pricing in enough Fed rate cuts going into next year.
I don't think it's so important who heads the Fed, but it is important that we get the Fed cuts. And I think it's important we get more than what the market's pricing and faster. Okay. So as we were discussing this afternoon, I do think that the market has been correcting now for 2 months. I mean, yeah, the S&P's down 2%, but there are a lot of stocks that are down 20, 30, 40%. Crypto is another kind of reflection of that. So I believe that there's not quite enough liquidity in the system for the financial markets.
Yeah, really interesting, Steve. I mean, I think Morgan Stanley's S&P forecast for next year is 7,800. This is the lead story in the FT right now.
Yeah. They've put out all their estimates, haven't they? A lot of the big US players as well. And 7,500 by the end of 2026, roughly 10% increase. That seems to be the mean of the 9 major US banks as well. But you're absolutely right. Morgan Stanley coming in at 7,800. So the conversion of Mike Wilson is quite extraordinary, because I'm pretty sure for a long part of this rally upwards, he was quite bearish.
Well, there's room in heaven for a sinner that repenteth, isn't there? I mean, I think Deutsche Bank are the punchiest out there in that sort of range, 8,000.
Yeah, very interesting. Especially seeing as there was some copy earlier in the year, talking from, I think it was Goldman Sachs, talking about an average 3% return on the S&P over the next 10 years. Well, the way the market's going, it's going to do that in the first 2 years of it. So does that mean we're going to get nothing in terms of growth thereafter? But anyway, we've got a senior economist on set.
We do indeed, yes. Fabio Barboni is the senior European economist at HSBC, and he joins us now. Fabio, great to see you this morning. Obviously, the big news event in the Eurozone this week has been the inflation numbers. Has that changed your thinking at all?
Not necessarily, but you guys were talking before about the market desperately looking for dovish cues, and actually, I mean, inflation has probably marginally surprised to the upside in the eurozone the last three prints, and services stands at 3.5%, so uncomfortably high. So I think, there's a chance that the market could actually be disappointed in looking at some of those dodgy signs.
I mean, your central case for next year is no movement from the ECB. Presumably that is reinforced by that services figure.
Absolutely. I mean, it's a bit of a dull forecast, but I think it's the bar is very high for the ECB to cut again. I think there'll be an on hold in December for the fourth time in a row, so that's pretty much the end of a cutting cycle. There will be a new forecast, which will be in focus. Everyone is looking for this inflation undershooting, so inflation undershooting 2% for 2026, 2027, 2028. But ultimately, we think that even on that front, there's a risk that people might be disappointed. Yes, there will be an undershooting, but it's not going to be big enough to get people really discussing about further rate cuts.
Fabio, let's cut to the chase. Long before Draghi put his put in, he actually said, I will give you some form of a bulwark for defence, I will support the economy, but I will only do it if you guys start thinking seriously about structural reform. I think that was about 14, 15 years ago, is right. So what is going on with the structural reform in Europe? I don't even think necessarily interest rate cuts across Europe is going to make much difference and move the needle on the growth perspective. What every single senior person who I speak to from European businesses says is just, let's just cut to the chase and get the structural reforms done. Let's cut the red tape. Let's make it easier to do business in Europe. That's going to make the difference, isn't it?
Yeah, absolutely. I mean, 25, 50 basis points is not going to push firms to invest given the uncertainty that there is out there. Germany wasn't investing even when rates were negative. Exactly. So there's certainly kind of an important point about reforms. I think what has changed, however, in the ECB now, maybe relatively to the Draghi era, is that certainly Draghi was talking about reform, but he was also helping a lot of countries spend by doing a very generous QE program. Now we have a central bank that is doing exactly the opposite.
You just committed sacrilege and blamed Draghi for the inactivity and the foot dragging of so many. And I agree with you. What you're saying is, if you give people cover without making them do stuff, then you kind of giving them license to not make those reforms. Is that what you're saying?
I mean, partly yes. But certainly, I mean, we are here in an ECB that now is much firmer on the QT side. They're saying we're going to stick to QT, so sort of, we're not going to necessarily help you out with those bigger fiscal deficits. So there's certainly a stronger push towards doing some of those structural reforms, which you were saying are important. Try to get those huge pot of savings back into the economies, to the investment. But yeah, I mean, it's been more than a year since the Draghi report, and I don't think we've seen much implemented of that. So certainly the progress has been slow on that front.
No, very disappointing. I mean, there's going to be record government debt issuance next year. Is the ECB right to be keeping up QT at the pace that it has been this year?
I think, the ECB is sort of testing waters. I think they want to keep it going. So far, the situation has been very smooth. There's no signs of liquidity shortage in Europe. So I think, so far they've been right. I fear they might be a little bit overconfident about the fact that things are still going to be right in the future because, reserves are very heterogeneously distributed across the Eurozone. There's plenty in Germany, not very much in Italy or some of the periphery. So there is a risk that the situation might actually be a bit more volatile. You could get accident. So it's very important that the ECB stands ready to act. So I would say for now, yes, but I think maybe the ECB is starting to kind of taking a little bit too far in terms of the confidence that they have on quantitative tightening.
So why would they be doing that? Is that because they want to give themselves sufficient headroom to go again in the next crisis?
So this is one reason. I think, there's also a view back there, maybe they think that they can somehow reignite the bank interlending channel, so get banks to lend back to each other like they used to do before the global financial crisis. So I think they want to try to kind of shrink the reserves. They don't want to help the countries kind of do higher fiscal deficits. So there's a series of reasons, and I think probably that's right. It's true that the ECB is more constrained than other countries when it comes to kind of bond purchases program. But as I said, I think we're starting to get to the levels that probably, maybe second half of the year, the ECB ought to be maybe reconsidering what they're doing in terms of balance sheet.
You mentioned our shared disappointment that not enough letter reforms and Draghi reforms have come to the fore quickly enough. And the excuse from the European leadership is we've had other crises. We've had a trade war and we've had a real war on the continent. I keep hearing that and I'm kind of thinking, well, God, you've got a commission of tens of thousands of people, or hundreds. Can't you do more than two things at once? But that's my gripe. In terms of the German fiscal spending, though, and I keep seeing problems about Merz and his government and his coalition and concerns about pension reforms as well, are we seeing that side of the ledger actually getting working its way into the economy, i.e. the fiscal spending from Germany? Is it happening?
I mean, we saw the German Bundesbank just passing the budget for next year. It's very ambitious in terms of borrowing. In terms of the spending, so far we haven't actually seen much of the pickup. It will take time. What I fear is that, if it comes down to it, probably they will focus more on supporting demand. That's where you can get the money out quickly, and maybe some of the supply side reforms, some of the infrastructure will take longer. So ultimately, yes, it will probably support growth. It might support more nominal growth than real GDP growth, certainly in the near term. So there's even a risk from a German fiscal package that maybe it might be a little bit more inflationary than what the market thinks and hopes. But certainly so far, we haven't seen big signs in terms of the impact that this could have in terms of structural economy.
No, and what about the German consumer in all of this? I mean, we expect the taps to be turned on big style next year, and there'll be a kick at a German GDP growth. But what about consumer spending in particular?
Absolutely, and I think this is probably one of the biggest risks to the outlook in Europe, because we know that consumers in Europe tend to be what economists call ricardian. So if they fear there's going to more taxes coming in the future, they might save a little bit more. The labor market is starting to slow, so maybe people feel a little bit less confidence about being able to get a job if they lose the job that they have. So there is a risk that actually people start to save a little bit more. Same is in France, for instance, where certainly there's going to be some spending cuts and tax hikes to come. So there is a risk that actually that takes off a little bit of the, one of the key growth engine that we've seen in Europe so far this year, and that's consumption.
Right,
very nice indeed.
Got to leave it there, I'm afraid. Fabio Barboni, Senior European Economist at HSBC. Good to see you. Thank you.
Good to see you. Right, coming up on the show, Meta shares sink on a report that the social media giant is pulling back on what Mark Zuckerberg previously held as the growth engine of the company. Plus, the race for WarnerBros. Discovery reportedly nears the endgame. We'll have some details. And Dan will speak to Lawrence Golub, who is the CEO of the private credit giant Golub Capital. That conversation coming up at 7:30 London time. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Right, welcome back. Let's take a little look at where the cryptos are currently trading in the session. It's calmed down just a little bit after the oscillation we saw at the start of the week. 92,000 seems to be where Bitcoin has settled. Ether trading around 31.78. In terms of the week-to-date ride for Bitcoin, well, it all started off with those rumours of drawdowns and concerns about what the digital asset treasury companies were doing and where their MNAVs were looking at, which was all a bit concerning for those people who were trading on a strategy of owning Bitcoin but trading at a multiple of it. Our next guest says that Bitcoin's recent pullback is a sign of maturing phase in the cycle, adding that the macro backdrop is turning more constructive for Bitcoin and risk on assets. Matthias Imbach is co-founder and group CEO of Signum, which is the world's first regulated digital asset bank. Matthias, nice to see you. Thank you very much indeed.
Thank you.
Why don't I just ask you that question where I started off? I look at Michael Saylor's X posts and I think the phrase that comes to mind from one of the other commentators was quasi-messianic. Some of his posts are quite, well, they're quite colourful. And if you haven't seen Michael Saylor's posts, everybody, I thoroughly recommend you have a look. They're quite a trip, literally. But in terms of what those strategies are doing now and the coming down to earth of those DAT companies, what does that represent, Matthias?
Yeah, it's true that this year there was DATs have emerged and there was a bit of a hype around it. I would say strategy is a bit of a different animal in the sense that Michael has been doing this earlier than all the others that came, right?
5 years,
so he's been on it. So at least we cannot say that he's just jumping on it, on a hype, etc. He truly believes in this. When it comes to the actual strategies, I'm also conservative. I do not fully understand the concepts. I understand that obviously when number goes up, then this works very well because you can print shares, get more leverage on it, and then you can trade at an MNAV higher than 1. Now things have turned. They have turned not necessarily because of what the DATs are doing. There's been a series of small shocks that led to these liquidations, trades, the trade announcement with the US-China issue, etc. And obviously when price of the assets, of the underlying assets of that strategy comes under pressure, then of course also the share price comes under pressure.
But it's what it represents to me. And like, if you want to own Bitcoin, great. I get it. People see it as an alternative to fiat currencies, etc., alternative safe haven to gold. I understand. But what I don't understand, and I fear, is the mania around these kind of companies when they are trading above that MNAV of 1. Because they were trading at a multiple in many cases, 2, 3, 4 times in some cases. That represents to me utter irresponsibility for the people selling the product if they're trying to say we are worth 2, 3, 4 times, when all they're doing is buying and holding Bitcoin. That is their entire strategy, to put it in a kernel, to put it in a very succinct place as well. Doesn't that represent a mania which is still attached to Bitcoin and the rest of the cryptos?
Well, I'm not representing the DAT industry, so
I know
I'm not
you're
going to
not,
say. But what I can say,
what it represents.
Yes, I agree that this is the kind of setups that can lead to mania in times of exuberance. Of course, the proponents of these strategies would say it's not just buying Bitcoin; it's buying Bitcoin, giving access to broader markets, right? Because some time back it was not as easy for everyone to buy Bitcoin. Now it is much more easier because we have the ETFs,
such a good strategy that the biggest proponent of it now holds a $1.5 billion reserve. That's how good it is.
Yeah, and I agree. That was the reaction to all the criticism in the market, that he had to now raise cash, actually by diluting the shareholders, so that for the next 12 months he can pay dividends without any issues. I fully agree. It's a controversial strategy. Many of the CEOs, the founders I work with and talk to in the industry, there is some worries that this could be kind of lead to negative further market sentiment, which then puts the rest of the industry also under pressure. So that's very much on the cards. So we hope that's not going to happen. But then also must say, zooming out, this is just an overall still small element of the entire market, and also the strategies that go into it. So I would also not give it too much importance.
This is the point. You think that this market is maturing, that people are moving away from speculation, that the case for holding crypto now is more around diversification.
Yeah, absolutely. I think, we can talk about Bitcoin and Ethereum and maybe a bit the longer tail, but there's different reasons, and my argumentation will be different from the different sets. But Bitcoin, I would say Bitcoin's biggest strength is that it means different things for different people. For some, it's this truly new system which may challenge the current fiat system. I personally don't believe in this, but there's a growing number of people that do. There's a second element of people that believe this is store of value, the digital gold narrative. And then third, it's a cultural phenomenon, new generation, just that want things digital, that want things on-chain, and the combination of these three groups that in different phases have different convictions around it, that's what the true strength of Bitcoin is, in my view.
Are you saying then that you think as an asset class it will become less volatile over coming weeks, months, years?
Yeah, the weeks, months, years, that's a hard one to predict. We've seen again over the last, since October 10th, from top to bottom was almost a third of the value was lost. So I would expect even going forward, volatility will remain. But, volatility is not only negative. Volatility is also a sign of still some lacking market infrastructure and maturity, which also is driven by information asymmetry. And information asymmetry for investors are also bearing huge opportunities. And so I would say for those that truly understand the market and have what I believe in mid to long term, like 3 to 5 year horizon, it's a great opportunity. Over time, yes, as markets further mature and there's further integration in traditional finance, I would expect that volatility will calm down.
So your business Signum, but obviously you offer a range of services. Where are you seeing most demand? Which services are in most demand right now?
What has been a big change this year is, because we're doing B2C and B2B, also bank-to-bank business, is that the 180 that the US did with the regulatory framework, the Genesis Act, now the Clarity Act coming up, is that regulatory uncertainty has been or is about to be fully removed by the biggest capital market, right, 48%, the US. And so what we've seen is that a massive increase of RFPs, of banks getting ready for it and building the infrastructure. Whatever you want to do with blockchain, be it crypto, stablecoins or asset tokens, you need the base infrastructure of custody and trading and integrating it into banking procedures and policies, and that is what is happening right now. And we're seeing announcements, I'm sure you guys are reporting it as well, Bank of America, Vanguard. There's just every week it seems there's new banks coming up that will offer it, and that is exactly the kind of stability, the infrastructure that will drive the next phase of adoption.
And yet you've got a whole host of global central banks, systemically important central banks, who don't want to lose control of the monetary system as well. So is there a threat to the control, and it's very controversial. A lot of our viewers think, great, let's get the central banks out of the system. Others think, no, it's important for them to maintain control as well. Again, I don't want to personally dive into that one, but do you think that that is the danger, and actually that the central banks are acting as a positive force, or actually will thwart the development of stable coins, tokenization, etc.?
I think right now we have a very healthy debate across stable coins, deposit tokens, CBDCs, right? These are all different things, but built on the same infrastructure. Yeah. And I personally believe it is actually the combination of the three that will work well. All is needed. Stable coins can be privately issued by the circles, etc., of the world. They shall integrate with deposit tokens. Deposit tokens are issued by banks or conglomerates of banks. Right now, there's a lot of activity in this space. And I also know there's a lot of, I'm personally involved in some of these discussions. There's then alignments between banks, the regulator and the national banks, how these three, stable coins, deposit token and central bank digital currency, shall interact. Look, if we want to move things on-chain, and I think we have moved beyond the paradigm of will finance go on-chain, people believe this now, then we need all of it on-chain, both the cash leg and the asset leg. I do not believe that stable coins are a threat to national currencies.
But potentially they somewhat, I mean, look, the European Central Bank seems light years behind in terms of launching a central bank digital currency compared with what's going on in stable coins.
Yes, I mean, they were early in announcing it, I would say, even earlier than what happened in the US. But in classic US fashion, once they embrace something, they go all in and they go fast. And that's what we're seeing right now. So on the stablecoin front, there seems to be this clear notion that the US will dominate. Right now, 99% plus of stablecoins in the market are US dollar based. With the Genesis Act, you know, this is also a strategy of the Treasury to actually have more demand for US Treasuries in the market. So in that sense, makes sense, and to make sure to defend the US dollar dominance in the world. And in the EU, as it usually is the case, more risk measured, slower. It's the same with the regulatory frameworks. If you compare what's coming in the US versus MiCAR, it's just a reflection of the culture of how we approach financial markets in the different parts of the world.
Matthias, lovely to see you. Thank you very much indeed for joining us today.
Pleasure. Thank you.
Very nice to see you. Matthias Imbach, who is co-founder and group CEO of Signum. And for more on Bitcoin's recent drop and how history shows that this is just normal, apparently, take a look at, is that Arjun's piece? I think that's Arjun's piece. Again, I'm doing my eye test here. I think it says Arjun Carpool there somewhere. Check out CNBC.com. Futures to break look like this. We are called higher on European equities.